Welcome back, everyone. Tom Staub with Red Oak Development Group, the CEO. It's been some time since I put out a video for you all as I kind of taken a hiatus from the podcasting work to really focus on growing the business and scaling up. But that said, one thing that we're going to start doing is slowly getting back into the podcasting. And one of the things I'll be doing for you all is every quarter with our newest member of our team, an economist from UPenn. We'll be presenting to you all what we think is happening on the market in terms of real estate development, real estate, and help you all understand how we see the pulse of the market. There's a lot of news bits out there and headline news about crashes and interest rate hikes and everything else in between. And so when you look at the data, that's where the truth is, right? And so the intent of these calls that you'll be getting every quarter is really a deep dive into some of the metrics that we're looking at and what my economist is tracking at a macro and micro level. Okay. So with that said, I'm going to share a presentation. This past week, my company and I brought everyone to New Orleans. We do our semi-annual offsite where we plan and figure out our goals and basically a way to scale up the company, right? And what I wanted to do there is also present to them where I see the market today and where I am forecasting it to go in the next 6 to 12 months and potentially even further, okay? So that said, again, Tom Staub, CEO of Red Oak Development Group. We've been developing for, I don't know, 5, 6 years now. And for you that don't know me, we started in Arizona outside of Flagstaff, and we're now heavily involved in the Austin, San Antonio MSA. About 80% of our portfolio is in the Austin, San Antonio area, and about 20% is in the Flagstaff area. We're trying to expand into Phoenix. It's a market that, for whatever reason, has been difficult to expand into. But we're doing a lot of growth and development work in here in Austin. And as you can see, we're approaching almost 1,000 acres now in our portfolio under development, combined between lots developed and lots in development. About 3,500 lots currently in motion, about $250 million in valuation. And we're also now building these condos as part of our condo townhomes as part of our communities. So there's a lot of movement here, a lot of good growth. And so you can imagine the importance of us knowing the pulse of the market. Okay. And so what I'm going to show you today, now, again, it's kind of lagging in terms of the data. We do have Q4 data. I know it's April. We'll have a new report out here in May. And so we'll send you a new video and a new report. And some of these updates do include, data as of April. Okay. So I think overall, when you look at the housing market, I know there's a lot on the screen. There's a few key trends that we're seeing, right? One, home ownership is consistent around that 65% level. And that's been about the historical average for some time. So generally, we're seeing home ownership and the desire to own homes remain constant to the norm. We're seeing a lot of headwinds for entry-level buyers and those that are in that $250,000 to $500,000 price point. There's a lot of demand in that segment, and there's a lot of competition. And I keep telling people, and you see here, we all know that interest rates are going up. Even if interest rates go up, yes, it's going to push out 10, 20% of the overall demand potentially in that segment. There's still a long line of buyers lined up to pay a premium price for a home, right? Some other things that we're seeing construction starts grow in both single family and multifamily, but generally we're seeing more focus on the ground up development for multifamily. And I can go into a number of reasons as to why I think that is, but we can talk about that more later. Supply continues to be constrained. Existing homes are just not coming to market. People are staying put, especially as they think to themselves, well, if I sell this house, great, where do I go next? Right. So we're seeing a lot of supply constraint on existing homes, some new supply coming to market on the new construction, but generally still a tight market on supply. Appreciation on homes it's just gangbusters out there, 17% year over year. So if anyone's still predicting a crash or think there's a crash happening, I can tell you that is not what the data is showing. What's fascinating in this report, delinquency rates have dropped substantially from 2020 and continues to decline. One of the things we're seeing there is that banks are just getting better at lending out money. I believe I saw the average credit score of a home loan now is above 720, right? So this is not 2008 where there was bad debt being issued left and right. These are strong borrowers with good balance sheets, low debt to income ratios. So really strong in terms of the balance or the balance sheets of these banks and what they're providing in terms of loans. A big thing here that we'll get into is that, you know, typically investors pick up 12 to 14% of all homes out there. We're now at a 19% rate. So investors are swooping in, buying rentals. And this number it hasn't really been impacted yet by the investors. There's an $85 billion pool of asset or capital flocking to the single family market, which is really unfortunate when we need the homes out there for the entry level buyers, and Wall Street's coming in and buying all of it. So those are some high level trends. We'll go through a lot here. And again, this is supposed to be a dense update, and it's going to be like this going forward, where I provide what we see in the market from a supply, demand, and forecasting standpoint. Okay. Supply, again, this continues to be tight. And while we are seeing some growth in terms of new starts in both single family and multifamily construction, it's not where it needs to be. Okay. And we know that there's issues with inflation, there's issues with supply chain, right? And I talk to builders, I sell to builders. We're having to adopt our what they call a takedown schedule. And what that means is how fast can these builders absorb these lots? They're slowing down, but yet they still need the lots. So builders are starting to just build more slowly. The supply chain is really a problem, and it's interesting to me. And I won't get into politics, but we should be focusing more on supply chain than the actual inflation, which is just a measure, right? Supply chain is very clogged right now. If you go to the West Coast, you'll see cargo ships out the wazoo, all the way in the ocean as far as your eye can see. Those are goods that we need on site, right? And so, I know appliances and garage doors are months back ordered. So you can't build homes if you don't have the materials. And so, unfortunately, I think that supply chain constraint is going to be here for probably another 12 to 15 months, maybe more. And so we don't expect to see a big boom in new home starts for single family until that's relieved. Again, it'll keep going up because we need it, but it's going to be hard. So we have some headwinds there in terms of supply. Multifamily starts are just booming right now. Obviously, well, if you haven't seen, rents are increasing very quickly as well. So that makes all the numbers for these apartment complexes much more attractive. So yeah, supply continues to be constrained while there is some sign of some growth in supply. Okay. Going back to what I was saying earlier, you can see here on the right that existing homes are just plummeting in terms of supply. People are not leaving their houses, and as we increase in interest rates, the affordability comes down. So people that are in their home today with a lower assessed value, and therefore lower property taxes, and now higher interest rates, they can't really afford to get out of their current home to buy a home that costs more, and that will cost them more per month, right? So we're definitely going to continue to see existing home sales decrease, and that's unfortunate because we really need to see those homes pick up in supply to have people who can actually buy homes. So now, conversely, if you're a builder, that's good news for you. New homes, we need more, and yet those are also plummeting in supply, mainly due to supply chain issues, right? So we're seeing some pickup in supply in the new home starts. We're seeing a plummeting of the existing home sales, and we'll see that probably continue. But generally, we think that supply will remain constrained through at least the remainder of this year, potentially going into the halfway through next year as well. Okay. And just for you all out there, in case you don't know, generally a balanced market of supply and demand is between 5 to 7 months. And we're teetering in that 5 to 5.5 month for new home starts, and about 2 months for existing homes. Blended averages of around 3-ish months. So we're still really tight on supply. Demand. I mean, here we go, right? As much as the supply is constraining, there's still really strong demand across all homes. And this is really important to consider when we think about, okay, well, what does interest rates mean, right? If interest rates go to 6, 7%, does demand fall off so significantly where it tanks the market? And we'll go into a later slide as to why we don't think that's the case. But demand is still very strong across all segments of real estate. Now, I think again, this is all macro level detail. Okay, I think it is also market to market. You're probably seeing slight headwinds now in some of the markets that haven't grown as much, right? So Illinois, West Virginia, some of these rural towns that haven't really seen a lot of growth. They're probably going to start seeing some more headwinds first. Okay, so an interesting way to look at this, in times where margins compress across assets, investors have to go to secondary markets to find deals, and once those compress, they go to tertiary markets to find deals, and it keeps going on and on and on until you're in these kind of bodunk towns buying rentals that have a decent return on your capital, right? Well, those are the same towns that get smashed when we start seeing weakness in the economy. And so, if you want to find key signals as to is the market tanking, look to those small towns, right? Those small towns that have a population of 40,000 people, and have a very limited uh, economy in terms of diversity of what's being produced there, right? So, I think places like Charlotte and Raleigh, Durham, and Nashville and Austin, Texas, and Dallas, Texas, and frankly all of Texas and Phoenix, and the real hot spots right now in Denver, those are probably safe havens for some time. And there's so much demand in those cities that even if interest rates go above 6.5, 7%, I think we have enough demand to outweigh any sort of headwind that we're going to see there. And so it's obviously micro that you want to be checking into these markets, but generally what we're seeing here is that demand is just very strong across most of all real estate segments. Okay. Now here's one that we'll get into, and this is really going to drive a lot of kind of our thinking. Okay. This is also what Janet Yellen is focused on heavily, which is the affordability of homes. And unfortunately, it's coming down, right? And this is not what we want to see. We want to see affordability remain in that 120 to 140 range, with the norm being 120. What does that mean? As price appreciation goes up, obviously homes become less affordable unless wages keep up with that appreciation. Now we've seen wages go up, 6 to 9% year over year for some people, and some people who are in the entry level market have not seen that sort of wage inflation, more towards the 1 to 4%. Right. Well, compare that to the 17% year over year appreciation in homes, you're going to see that divide, broaden. Right. And so we are seeing affordability come down. It's a big concern from Janet Yellen. I'll tell you that when we go into these city council meetings and we present our concept plan for our master communities, the number one phrase is affordable housing. What is it? Where is it? Right. And that's actually why we focus in our sweet spot, which are the homes in the 250,000 to 500,000. We believe that even in a downturn economy, there's going to be tons of demand in that segment at all times. Whether it's entry level home buyer, whether it's the people who would have been able to afford a home that was $800,000, but now can only afford a home that's a 500,000. Right? We're playing in a segment that is going to have strong demand for some time, and that's kind of our bread and butter, right? But yeah, affordability will continue to be a problem here for the next 2 to 3 years. And as the interest rates go up, that doesn't make it any better. So where do we think demand is going, right? And this is kind of going back to the affordability question. And so this next slide is the math, and I have it on here. If you want to do the math yourself, this is how you do it. The housing affordability index really assumes that no more than a quarter of your gross income goes to a mortgage. Okay. And so what we end up doing is essentially at a one index, your monthly payment for a house is roughly one fourth of your overall income. Okay. And so again, we like to see that 1.2 to 1.5 range in affordability index. That's very healthy in terms of people being able to afford a home. And so in Q4, you can see here we were at a 1.5 with the average 30-year fixed mortgage rate of 3.11%. This was one of the main metrics driving a lot of the demand, right? And you can see that the average home price was $361,000 with an average mortgage payment of about $1,200, and this assumed a 20% down payment. Okay. So in order to afford that, you would need to make about $5,000 a month, or $60,000 per year. Well, you can see that the median income is $88,000, right, for a household. So there's plenty of room in terms of what people can afford, and that's why we're seeing, or we were seeing so much demand on housing. People had purchasing power, right, and that's shown in the 1.49, housing affordability index. Okay. Well, go to April 10th, rates boom to 5%, right? Massive. Well, you can see, all things being equal, the same home price, the same income, right? Now your required monthly income to buy that same house goes up, 25% or so to 6,200, right? So now you need to make $74,000 to afford that same home at the 5% interest rate. Okay. Well, we're still there. We're still at the 88,000 median income. And so you'll see that affordability index come down from 1.5 to 1.18. So now we're where we should be according to the norm, right? So we're still in a good spot generally across affordability. And keep in mind, there's still pent up demand. So we still need to get through all that demand first before this even really takes its course. So what my team and I do here is we say, okay, well, where would it get imbalance? Where do we think risk could be if we get there? And by the way, we're trying to predict 18 months, 24 months down the road so that we're not buying deals, buying land and sitting on it while no one wants to buy lots. Okay. So there's a lot that we take into account here. But where we see sort of the break point is around 6.5 to 7% on a 30-year fixed mortgage, right? And you can see here that at 7% mortgage rate, you're going to start seeing a lot of people not being able to afford homes anymore. Okay. Now, in an interesting way, if we get to 7%, that'll be a balancing act to probably wash away what is likely, 9 to 12 months of backlogged demand. Okay. So we have time, one. Two, we have plenty of room to go on interest rates. And while we do think the Fed will continue to raise rates slightly, I don't foresee rates going to 7% anytime soon. Okay. Now, again, I could be wrong, and we'll watch this very closely. And I think the next 90 to 120 days will tell us a lot. But so long as we're below that 7% interest rate mark on a 30-year fixed, I think we're going to have a rather balanced market. And in fact, I do think mortgage rates should be in that 5.5 to 6.5% range. That's going to balance a lot of the supply and demand out over time. But keep in mind, there's still a backlog of demand that we have to get through, and we still have to build supply. So we need the rates to probably stick around 5 to 6.5% for a good 3 to 4 years before that market really corrects itself back to to equilibrium, if you will. Again, this is what we believe. Okay. And again, just a quick note on rental demand. We're seeing a lot of demand on rentals. So if you own rentals, then you're probably seeing the opportunity to increase rents. And obviously, this is driven by homes becoming more unaffordable. This will continue to happen. We think rents will continue to increase, especially for the single family homes, maybe a bit slower for multifamily. Um, and so again, that puts more pressure on people wanting to buy a home because as rents go up, well, then naturally it makes logical sense to buy a house if you're paying more for rent than you would a house, right? And so this is also important to watch. Not as important as affordability, but it is one of the things that are going to drive demand supply. Okay. One thing I found fascinating in this report is that we're Americans are doing really well in terms of homeowner wealth. Now, again, there's obviously a big wealth gap, and there's a part of the economy that's not doing very well, and that is unfortunate. And there's a lot of people that are doing very well, and a lot of their equity or a lot of their wealth is tied up into their home. Okay, so in California, it's known as the California 401k, right? And so we are seeing a lot of health financially in home ownership right now. And so, it goes to kind of say, well, look, if you're in a house in the last couple of years, you made some good money, right? And so there is some tied up equity there that could be tapped in a downturn situation. So, given that we're a developer, is I'm constantly tracking what the builders are thinking and saying, and I have sit downs with them over beers or lunch about once a month, and these are big builders, top 5, top 7 in our nation. I sit down with them, I have a one-on-one and say, tell me what you see coming. What are you afraid of? What are the risks that you see? Okay. And generally the overall sentiment is that builders are still pretty bullish. They're a little skittish now with interest rates. Everyone's watching it. But from the corporate down to the purchasers, it's still game on. It's still, especially if you're in the Austin, San Antonio MSA, there is still a glut of demand they have to get through, right? So I do think builders are a little more cautious than they were in '08. They're not going to be as, I guess, chaotic in their buying patterns, but generally it's still strong. And you can see back in Q3 of last year, Q4, we had a record high confidence from builders, 83, 84. Now, you can see here that in the sentiment index here, below 50 is not great, right? They get to 50 and they start to get concerned. That's where we see contraction in this business, okay? So we're definitely watching this, and some of the best intel that I can get is out to lunch with the builder, right? So I'm talking to them all the time to understand what are they thinking. Now, if you look at what's being forecasted, in the next 6 months, this sentiment or confidence level is expected to be in the 68 to 73 range, meaning for the next 6 to probably 9 months, builders are going to remain bullish in the market. And I think we're all watching generally to see where the interest rates go. Again, if it goes above 7%, I think this will obviously come down, probably 60, maybe below 60. So we just have to watch this in parallel with the interest rates and everything else in between. Okay. And then one thing that I use quite a bit is what is called the lot supply index. And again, you get this from Zonda, who I work with on my data, and as does many other builders, as do many other builders. And so you can see here that what builders are forecasting for demand is way below the supply of lots. And that's where we come in, right? Red Oak buys the land, we build out the improved lots. Sometimes we build on them, but most of our bread and butter is selling off these lots to the builders, right? So for our business, we're in a really good situation, a good time to help builders find improved lots. And I won't go into the negotiations that we're seeing, but this is definitely in line with how, frankly, how easy our negotiations have been to sell these lots. And knock on wood, I've been expecting a turnaround on this with everyone kind of chasing the market. We're just not seeing the supply that we need, and I think this will continue for a good 4 to 6 quarters until the lots come to market. Okay, so again, we watch this very closely. This is our bread and butter in terms of what we make and what we do. So we're watching this very closely. Okay. Now, I want to talk about where we're focusing, right? Again, we develop mostly in Austin, Texas. We don't develop in Austin because it's politically just a pain in the butt to get anything done there. So us and many other developers, we operate right around the peripheral of Austin, right? And one of the areas is Lockhart, Texas. And you wouldn't know what this really is. I didn't really know what it was when I moved here. But essentially, one, it's the barbecue capital of Texas. And if you ask them, it's the capital of the world in terms of barbecue. And there's some really big things happening down there, right? We're focused heavily in Lockhart. Almost half of our book or half of our portfolio is in the Lockhart general area. And one of the things that is coming as an announcement, I believe, sometime in June, is a major manufacturing semiconductor company will be announcing what we think is a 20 to $30 billion injection into that area. Now, what that means, you think about Amazon HQ2. Okay, well, that's essentially going to happen. At least we think it is from what we have heard in this Lockhart area. And you have a lot of big developers hearing the same thing. And we think there's a massive boom just ahead of us, right? And so, and we've thought this for probably since August of last year, right? You think about where Lockhart is, it's 30 minutes from Austin, just going south. It's a pretty quick drive. And it's about 45, 50 minutes from San Antonio. So it's situated in a really ideal spot for a number of things, especially manufacturing, logistics, Amazon fulfillment centers. There's a university in San Marcos down there. There's a lot of good communities growing down there. And by the way, the housing price points are $350 to $500,000, right? So affordable housing, relatively speaking. And so we are very bullish in Lockhart. And you can see the graphs here, just plummeting supply, right? Plummeting inventories. And so we are very bullish in this area. And I think in the next 3 to 6 months, if you follow me and you follow Lockhart, Texas, I think you'll be surprised at what's happening. So this is mostly where we get our investors involved in our deals. You'll find it in Lockhart. And we have to date about 2,000 lots under development in Lockhart, right? So 2,000 of our 3,500 lots are in development in Lockhart, Texas. So we're putting our eggs in this basket, and we'll see what happens. So with that said, again, that's a general overview of the market. Again, to recap, interest rates are of concern, naturally. We're closely monitoring the affordability index, and just again, let's track that and see where that goes. Interest rates going to 7% would be concerning for us, But generally, right now, we see strong demand in real estate continuing for some time. We see supply just not meeting what we need to meet, and that's based on inflation as well, supply chain constraints. We see a massive shortage in lots for builders. And generally, we think if you're going to play it safe, then there's really no better place to play right now than Austin and San Antonio MSA. And within that, one of the big towns that we're focused on is Lockhart, the barbecue capital of the world. And with that, if you have any questions, feel free to reach out to me. And if you're interested in any of our deals, we do offer investors an opportunity to invest. You can reach me at tom@redoakvc.com, and I'll see you next quarter. Thanks.